Seller financing is a very interesting option for acquiring a business. And so I decided to make a whole section just on this within the course because it's so unique and valuable. And I really want to explain the nuances of what it is and how it works well. So, seller financing, for those who don't know, occurs when the seller agrees to finance part of the purchase price. This option can be really attractive for both buyers and sellers as it allows a greater amount of flexibility into the deal and can help facilitating getting a deal done, sometimes when other financing options don't work. The first thing you want to do is negotiate the terms with the seller. And in a seller finance deal, here's how it typically looks. The buyer makes a down payment, the seller provides financing for the remaining amount, and the buyer then repays the seller over time with interest based on agreed upon terms. So the three key components are down payment, interest rates, and repayment terms. So the down payment typically is 10 to 30% of the purchase price, more towards 30 than 10. And this is so that the seller gets something, material out of the deal. They know that you're in it and you're serious. And if they turn the business over to you, they want to make sure they get something for all their hard-earned work to get this business to where it is today. Interest rates. The interest rate is negotiated between the buyer and the seller, but it often is lower than what a traditional lender will offer. Repayment terms, depending on the agreement, this can be anything, but the repayment period typically ranges from 3 to 10 years. Payments can be structured similarly for a loan with monthly or quarterly payments. Of course, there are advantages and disadvantages of seller financing. The advantages are that there's an easier approval process. Seller financing might be more accessible for buyers who have difficulty securing traditional financing due to credit or collateral issues. There's incentives for sellers. Offering financing can help close the deal faster, especially if the buyer doesn't qualify for the traditional financing. It also allows the seller to receive interest income over time. And then there's shared interest. Since the seller is financing part of the deal, they have a vested interest in the business's ongoing success, which can foster better collaboration during the transition period and beyond. So 3 advantages. So there's 2 disadvantages I want to cover. The first is limited seller financing. Sellers typically won't finance the entire purchase price, so you still need to come up with some additional financing source to make up the difference, whether it's the 10 or 30%. And then there's a risk for buyer and seller. If the business underperforms, the buyer may struggle to make payments and the seller may not recoup the full purchase price.